Why China just moved $688 billion out of the U.S. financial system. In October 2025, China's holdings of U.S. Treasury bonds dropped to $688.7 billion, the lowest level since November 2008. That's a 47% decline from its peak of $1.32 trillion in November 2013. And here's what nobody's telling you. This isn't about trade tensions. This isn't about Trump's tariffs or Xi Jinping's economic policy. This is about something far more fundamental. China is dismantling 50 years of American financial architecture, and they're doing it systematically, deliberately, and irreversibly. This is the story of how the world's second largest economy is preparing for a post-dollar world, how $688 billion is just the beginning, and why every American, whether they know it or not, is about to feel the consequences. Because when China moves nearly $700 billion out of the US financial system, that's not a withdrawal, that's a declaration. Let me show you what they're really doing, why it's happening now, and why there's no turning back. The pattern. Nobody's seeing. Before we understand what's happening, you need to see the pattern. China held over $1.3 trillion in U.S. Treasuries in 2013. By 2022, that dropped below $1 trillion. By April 2025, $757 billion. By October 2025, $68.7 billion. That's 9 months of consecutive declines in 2024 alone. This isn't volatility. This isn't market timing. This is systematic divestment. And the numbers tell a story most analysts are missing. In 2022, China cut Treasury holdings by $173.2 billion. In 2023, another $50.8 billion. In 2024, another $57.3 billion. Every single year, the selling continues. Every single quarter, the position shrinks. But here's where it gets interesting. While China has been selling treasuries, they've been doing something else, something most people haven't noticed. China's foreign exchange reserves actually increased in September 2025 to $3,087 trillion, up of course 5% from the previous month. Think about that. They're selling American debt, but their total reserves are growing. The money isn't disappearing, it's moving. And where it's moving tells you everything about what's coming. The 3 reasons behind the move. Analysts will tell you China is selling treasuries because of trade tensions, because of tariff wars, because Trump imposed 145% tariffs on Chinese goods, and China retaliated with 84% tariffs on American exports. That's part of it. But it's not the whole story. There are 3 reasons China is moving $688 billion out of the US financial system, and only one of them has anything to do with America. Reason 1, the weaponization of the dollar. In February 2022, Russia invaded Ukraine. Within days, the United States and European allies froze over $300 billion of Russian foreign reserves. Money that Russia held in dollars, in euros, in Western banks became inaccessible overnight. Russia, a nuclear superpower, was cut off from its own wealth through financial sanctions. This moment changed everything for China, not because China supports Russia's invasion, but because China realized the same weapon could be used against them. The US dollar isn't just a currency, it's a control mechanism, and whoever controls the dollar-centric financial system controls access to global trade. China holds $3.3 trillion in foreign reserves. If the US can freeze $300 billion of Russian money, they can freeze $3 trillion of Chinese money. One executive order, one sanction, and China's foreign reserves become worthless. This is why China has been systematically reducing dollar exposure since 2013. But after 2022, after watching Russia get cut off, the selling accelerated. Between 2022 and 2025, China dumped over $280 billion in US Treasuries. That's not market management, that's de-risking. China is moving money out of the dollar system because the dollar system can be weaponized against them, and they're not taking that risk anymore. Reason 2, China's domestic economic crisis. The second reason is something most Americans don't understand. China's economy is in serious trouble. Not the kind of trouble you read about in headlines, the kind of trouble that threatens the entire Chinese financial system. China's property sector, which represents 70% of household wealth and 25% of GDP, has been collapsing since 2021. Evergrande, once China's largest property developer, defaulted on over $300 billion in debt. Country Garden, another giant, is restructuring $11.6 billion in offshore debt. Vanke, considered one of the high-quality developers, reported a record $6.8 billion loss in 2024. Housing prices have fallen 20% or more since peaking in 2021. New construction is down over 20% year on year. Property sales have collapsed. And because 70% of Chinese household wealth is in real estate, the wealth effect has been devastating. Chinese consumers are not spending. Household bank deposits have doubled in the past 5 years as people save instead of consume. Consumer confidence is shattered. And the government is desperately trying to stabilize the economy. Here's where the Treasury selling comes in. To support the yuan and prevent capital flight, China needs liquidity. Selling U.S. Treasuries provides that liquidity. Between 2022 and 2024, as the property crisis deepened, China sold nearly $300 billion in treasuries. The money went to shore up the yuan, to inject capital into struggling banks, to prevent a financial crisis from becoming a catastrophe. This isn't strategic repositioning. This is crisis management. China is selling American debt to keep its own economy from imploding. Reason 3, building a post-dollar world. But the third reason is the one that matters most. And it's the one nobody in Washington wants to talk about. China isn't just moving money out of the dollar system, they're building an alternative to the dollar system. And they're doing it systematically, with precision, across 3 fronts. Front 1, yuan internationalization. In 2010, 0% of China's imports and exports were settled in yuan. By 2024, over 50% of China's cross-border trade is settled in yuan. The yuan is now the 5th largest international reserve currency, making up 2.7% of global currency reserves. That's still small compared to the dollar's 53.6% share. But the trend is unmistakable. China is pushing the yuan globally. They've signed currency swap agreements with over 30 central banks, including the UK, the European Central Bank, and Canada. Russia and China now settle most bilateral trade in yuan or rubles. Saudi Arabia is exploring yuan-denominated oil contracts. India is paying for Russian coal in yuan. Bangladesh is paying Russia for a nuclear power plant in yuan. By 2023, 1/5 of global oil trade was settled in non-dollar currencies. That's a dramatic shift from the near-universal dollar dominance that existed just a decade ago. And China is at the center of it. Front 2, the digital yuan. China has rolled out a digital version of the yuan, the eCNY, to replace cash and coins. It's been tested in millions of transactions across multiple cities and in cross-border pilots with Hong Kong and the UAE. In September 2025, the People's Bank of China announced plans to set up a center for digital yuan internationalization in Shanghai. They're promoting yuan foreign exchange futures. They're allowing foreign investors to trade 16 more futures and options contracts in mainland China. This isn't just currency modernization. This is building infrastructure for a post-dollar payment system. The digital yuan allows China to conduct international trade without touching the dollar system, without using SWIFT, without exposing themselves to Western financial sanctions. It's the ultimate de-risking tool. Front 3, gold accumulation. While China has been selling treasuries, they've been buying gold, massive amounts of gold. China has been one of the world's largest gold buyers over the past decade. Turkey, India, and China have led global central bank gold purchases. Gold represents 2.7% of China's foreign reserves now, up from negligible amounts a decade ago. Why gold? Because gold can't be frozen. Gold can't be sanctioned. Gold is the ultimate safe asset in a world where dollars can be weaponized. Every ton of gold China buys is a ton less exposure to dollar-based assets that could be frozen overnight. The mechanism. How China is actually moving the money. Now, let me show you how China is actually moving $688 billion out of the US financial system, because it's not as simple as pressing a sell button. From 2013 to 2025, China's official treasury holdings dropped from $1.32 trillion to $688.7 billion. That's $631 billion in net selling over 12 years. But here's the complication. Not all of China's treasury holdings show up in official Chinese government accounts. Some Chinese holdings are held through Belgium's Euroclear, a custodial service. When you adjust for Euroclear holdings, China's total treasury exposure is higher than the official number. But even accounting for this, the trend is clear: massive divestment. In December 2024 alone, China sold $9.6 billion in treasuries. In the first 5 months of 2024, Chinese investors dumped a record $79.7 billion in U.S. stocks and bonds combined. Over half of those sales were treasuries. The rest were agency debt and equities. This is across-the-board dollar divestment. But where's the money going? Destination 1, yuan-denominated assets. China is converting dollar debt into yuan debt. Ethiopia recently announced it would convert $538 billion owed to Beijing from dollars into yuan-denominated loans. Kenya cut annual debt servicing costs by $215 million by converting Chinese railway loans from dollars to yuan. Hungary and Kazakhstan sold yuan-denominated bonds in 2025. Sri Lanka took a $500 million yuan loan for a highway project. China is using its position as the world's largest creditor to push the yuan. Debtor nations get lower interest rates. China gets broader yuan usage. It's a win-win that reduces global dollar dependence. Destination 2, domestic investment. China is redirecting capital to domestic priorities. In September 2025, China announced a $70.3 billion policy-based financial instrument to support infrastructure and investment. In February 2025, China announced a $55 billion capital injection into major banks to shore up the financial system. This money has to come from somewhere. Selling treasuries provides liquidity to fund domestic stimulus without printing more yuan. Destination 3, gold and commodities. China has been accumulating gold, oil reserves, and strategic commodities. They're building a resource buffer that doesn't depend on dollar-based markets. They're stockpiling the physical assets that matter in a world where financial sanctions are increasingly common. Why this time is different? You might be thinking, China has been reducing treasury holdings for years. What makes this moment different? 3 things make 2025 a turning point, and they all happened in the last 12 months. 1. The Trump tariffs. In April 2025, Trump raised tariffs on Chinese goods from 54% to 145%. China retaliated with 84% tariffs on U.S. exports, valued at $244 billion in 2024. This isn't negotiation. This is economic war. And in an economic war, China isn't going to keep $700 billion parked in the treasury of its adversary. The tariff war gave China political cover to accelerate treasury sales. What was already happening slowly is now happening fast. 2. The petrodollar expiration. In June 2024, the 50-year petrodollar agreement between the U.S. and Saudi Arabia expired. For 5 decades, Saudi Arabia agreed to price oil exclusively in dollars in exchange for U.S. military protection. That agreement is over. Saudi Arabia is now exploring yuan-denominated oil contracts. They've signed a $7 billion currency swap agreement with China. 20% of global oil trade is now conducted in non-dollar currencies. When oil stops being priced exclusively in dollars, the demand for dollars collapses. And China knows this. They're positioning the yuan as the alternative before the dollar's oil monopoly completely erodes. 3. China's property crisis escalation. In late January 2025, China bailed out Vanke, one of the last surviving property giants. This was the first mainland rescue of a major developer. It signals that the property crisis is reaching a critical phase. China needs liquidity. Fast. Selling treasuries is the easiest way to raise billions without triggering currency devaluation or inflation. Between the property crisis and the tariff war, China has every reason to liquidate dollar assets now. The consequences for America. So what does this mean for the United States? What happens when China moves $688 billion out of the U.S. financial system? Let me walk you through the cascade. Consequence 1, upward pressure on treasury yields. When China sells treasuries, supply increases. More bonds on the market means prices fall. When bond prices fall, yields rise. In April 2025, the 10-year treasury yield spiked to 4.5%, the highest since November 2024. The 30-year yield jumped 48 basis points in 1 week. Part of that was China selling. When the second largest foreign holder of treasuries dumps bonds, it moves markets. Higher yields mean higher borrowing costs for the U.S. government. The U.S. owes $38 trillion. We're paying nearly $1 trillion per year in interest. If yields rise just 1%, that's hundreds of billions in additional annual interest payments. We're already spending more on interest than on defense. Higher yields make that worse. Consequence 2, dollar volatility. When China sells treasuries, they're selling dollars. Those dollars flood back into global markets. Too many dollars chasing too few assets means the dollar weakens. In April 2025, the dollar lost 7.5% against a basket of global currencies, the steepest losses of the year. Part of that was China's divestment. A weaker dollar is good for U.S. exports. It makes American goods cheaper abroad. But it's bad for Americans buying foreign goods. It makes imports more expensive. It drives inflation. In a country that imports $800 billion more than it exports annually, a weak dollar is a tax on consumers. Consequence 3, loss of reserve currency status. This is the big one. The US dollar is the global reserve currency because the world needs dollars to buy oil, to trade internationally, to hold as safe assets. But what happens when oil is priced in yuan? What happens when China, Russia, India, Brazil, and half of Africa are trading in yuan, rubles, and local currencies? What happens when central banks hold more gold and fewer treasuries? The dollar doesn't collapse overnight, but its dominance erodes, slowly, steadily, and once it starts, it accelerates. Because reserve currency status is a network effect. The dollar is valuable because everyone uses it, but if everyone stops using it, the value collapses. Britain learned this in the 1940s. The pound sterling was the global reserve currency for 200 years. Within 20 years of losing that status, Britain went from superpower to regional economy. The same could happen to America, and China, selling $688 billion in treasuries, is a step toward that future. But China can't stop now. Here's the critical part. Even if China wanted to stop selling treasuries, they can't. They're locked into a trajectory that makes continued divestment inevitable. Lock in one. The property crisis isn't over. China's property sector is still collapsing. Vanke lost $6.8 billion in 2024. Evergrande is delisted. Country Garden is restructuring. Housing prices are still falling. Household wealth is still declining. Consumer spending is still weak. China needs liquidity to stabilize the economy. And the easiest source of liquidity is selling treasuries. As long as the property crisis continues, and it will for years, China has to keep selling. Lock in two. The yuan push is structural. China has spent 15 years building yuan internationalization infrastructure, currency swaps with 30 central banks, digital yuan pilots, yuan-denominated oil contracts. This isn't a policy experiment. This is China's long-term strategy. And the strategy requires reducing dollar exposure while increasing yuan circulation. That means selling treasuries and redirecting capital to yuan-based assets. It's not optional anymore. It's structural. Lock in three. The geopolitical reality. The US and China are not partners. They're rivals, strategic competitors in the most important economic and technological competition of the 21st century. China watched Russia lose $300 billion overnight because of dollar-based sanctions. They know the same could happen to them over Taiwan, over trade, over anything. As long as the dollar system can be weaponized, China has to reduce exposure. That means selling treasuries. Period. The tipping point. Nobody's calculating. Now, let me show you the tipping point. The moment when China's treasury selling shifts from manageable to catastrophic for the U.S. financial system. Right now, China holds $688.7 billion in treasuries. That's 7.4% of all foreign-held U.S. debt. Japan holds $1.2 trillion. The UK holds $877.9 billion. Between the three of them, they hold over $2.7 trillion and 29% of all foreign-held U.S. debt. But what happens if Japan and the UK follow China's lead? Japan is already selling. In December 2024, Japan dumped $25.6 billion in treasuries. In the first 4 months of 2025, Japan sold another $227 billion that the UK sold $44.1 billion in December alone. If all three countries continue selling at this pace, that's over $300 billion in annual divestment. The US issues about $1.5 trillion in new debt per year. If $300 billion in demand disappears, that's a 20% reduction in foreign buyers. Who fills the gap? The Federal Reserve, through quantitative easing, which means printing money to buy government debt, which means inflation, or domestic investors, pension funds, mutual funds, banks, which means crowding out private investment. Capital that could go to businesses, to innovation, to growth, goes instead to funding government deficits. Either way, it's bad. But here's the tipping point. If foreign demand for treasuries drops below a critical threshold, yields spike. If yields spike too fast, borrowing costs explode. The U.S. government can't afford to service $38 trillion in debt at 6% or 7% yields. That's $2 trillion to $3 trillion in annual interest payments. More than defense, Medicare, and Social Security combined. At that point, the debt becomes unsustainable. The government has to choose: cut spending dramatically, raise taxes dramatically, or default. Spain faced this in the 1600s. Britain faced this in the 1940s. The Soviet Union faced this in 1991. All three made the same choice: print money, devalue the currency, accept economic collapse, and all three lost their status as global superpowers. China's $688 billion move isn't the tipping point, but it's accelerating us toward it. And once we cross it, there's no going back. What China is really building, let me show you what China is building with the money they're pulling out of the US system. Because this isn't just about selling treasuries, it's about building an entire parallel financial architecture. Architecture 1, the M-Bridge platform. In January 2025, the Asia Society Policy Institute published a report on China's M-Bridge platform. It's a multi-currency digital payment system involving China, Hong Kong, Thailand, and the UAE. Initially supported by the Bank for International Settlements, the platform allows instant cross-border payments in yuan, baht, and dirham without touching the dollar or SWIFT. Transactions settle in seconds. No dollar conversion, no US oversight, no sanctions risk. This is the future China is building. A payment system that bypasses America entirely, and it's already live. Architecture 2, the Belt and Road Digital Currency Network. China has invested over $1 trillion in Belt and Road infrastructure projects across Asia, Africa, and Latin America. 70 countries, critical ports, railroads, power plants, telecom networks. Now, China is layering digital currency infrastructure on top of that physical network. Countries that owe China money can repay in yuan. Countries that trade with China can settle in yuan. The entire Belt and Road becomes a yuan-denominated economic zone. 70 countries, 4 billion people, operating outside the dollar system. Architecture 3, the BRICS alternative. Brazil, Russia, India, China, South Africa. The BRICS nations represent 47% of global population and 26% of global GDP. They've been discussing a BRICS currency for years. While a unified currency is unlikely, what's emerging is a BRICS payment system. Member nations settling trade in local currencies, using digital currencies, bypassing the dollar. China is at the center of this, providing the technology, providing the yuan as a bridge currency, providing the vision for a multipolar monetary system. The pattern we've seen before. This isn't the first time a reserve currency has been displaced. It's happened 3 times in the last 500 years, and every time it follows the same pattern. In the 1600s, Spain was the global superpower. They controlled the world's gold and silver. The Spanish real was the reserve currency, but they overextended militarily, debased their currency, accumulated unsustainable debt, and within 80 years, they collapsed. The Dutch guilder replaced the Spanish real. In the 1800s, Britain ruled the largest empire in history. The pound sterling was the global reserve currency. But 2 world wars drained Britain's gold reserves. They borrowed heavily from America, couldn't maintain the empire, couldn't defend the currency. By 1950, the pound collapsed. The US dollar replaced the pound. Now we're watching it happen again. The US dollar has been the global reserve currency since 1944, 81 years. But we're following the same pattern Spain and Britain followed. Military overextension, 750 bases in 80 countries, wars in the Middle East, NATO commitments, Taiwan, Ukraine. We can't defend it all. Currency debasement. The dollar has lost 98% of its purchasing power since 1971. We've printed $6 trillion since 2020 alone. Unsustainable debt. $38 trillion and growing. Interest payments approaching $1 trillion per year. We're running $1.8 trillion deficits during peacetime in a growing economy. We're in stage 5 of 7. The same stage Britain was in 1940, the same stage the Soviet Union was in 1985. And China knows this. That's why they're moving $688 billion out of the US financial system. Not because they're attacking America, because they're preparing for the inevitable. The dollar's dominance is ending, and China is positioning the yuan to fill the vacuum. Why this should terrify you. Here's why you should care about China selling $688 billion in treasuries, even if you don't own stocks, even if you don't follow markets, even if you think this is just financial abstraction. When China moves money out of the US system, it affects you directly. Effect 1, higher interest rates. When Treasury yields rise, mortgage rates rise, car loan rates rise, credit card rates rise, student loan rates rise. If you're borrowing money for anything, it gets more expensive. A 1% increase in mortgage rates adds $200 per month to a $300,000 mortgage. That's $2,400 per year. That's real money out of your pocket. And it's happening because China is selling treasuries. Effect 2, inflation. When the dollar weakens, imports get more expensive. Electronics from China, cars from Japan, oil from Saudi Arabia. Everything costs more. If the dollar loses 10% of its value, your purchasing power drops 10%. Your salary stays the same, but everything you buy costs 10% more. That's a 10% pay cut in real terms. And it's happening because China is diversifying away from dollars. Effect 3, economic instability. When reserve currency status erodes, economic volatility increases. The VIX volatility index hit 52 in April 2025, a level only seen during the 2008 financial crisis and the 2020 COVID pandemic. Markets swing wildly, recessions become more likely, your job becomes less secure, your retirement savings lose value, and the underlying cause is the unraveling of the dollar-centric financial system that China is accelerating. The future nobody's preparing for. Let me show you 3 scenarios for where this goes, because China's $688 billion move is just the beginning. Scenario 1, managed decline. The optimistic scenario, China continues selling treasuries gradually. The US adapts by finding new buyers. Japan and Europe step up. The Federal Reserve manages the transition. The dollar remains the dominant reserve currency, but loses market share. The yuan becomes a major alternative. A multipolar currency system emerges. Dollar share in global reserves drops from 53% to 35% over 10 years. Not a collapse, just a decline. But even in this scenario, Americans get poorer. Higher interest rates, lower purchasing power, slower growth. The exorbitant privilege of reserve currency status ends. And we have to live like every other country, earning our way instead of printing our way. Scenario 2, accelerated fragmentation. The realistic scenario. China's property crisis deepens. They need more liquidity. They sell treasuries faster. Japan follows. The UK follows. Foreign demand for US debt collapses. Yields spike to 6% or 7%. The US government faces a debt crisis. We have to choose between austerity, default, or printing money. We choose printing. Inflation surges to 10% or higher. The dollar loses 30% to 40% of its value over 5 years. The yuan, euro, and gold all gain reserve currency status. Global trade fragments into regional currency blocks. US influence collapses. We become a regional power, still powerful, but no longer dominant. Scenario 3, sudden collapse. The catastrophic scenario. A geopolitical shock triggers a crisis. Taiwan. Ukraine escalation. A major terrorist attack. Confidence in US stability evaporates. Foreign holders dump treasuries all at once. China, Japan, Saudi Arabia, everyone. Yields spike to 10% or higher. The US government can't service the debt. We default. The dollar collapses. Hyperinflation. Economic depression. The same collapse that destroyed the Soviet Union in 1991, 900 days from superpower to non-existent. This scenario is unlikely, but it's possible. And the more China, Japan, and others reduce treasury holdings, the more vulnerable we become to a sudden shock. The 3 things you need to understand. As we close, let me give you the 3 critical things you need to understand about China moving $688 billion out of the US financial system. 1. This is structural, not cyclical. China isn't selling treasuries because of one policy or one president or one trade war. They're selling because the entire dollar-based financial system has become a strategic vulnerability for them. As long as dollars can be weaponized, China has to reduce exposure. This isn't stopping, it's accelerating. 2, the consequences are already here. You're already feeling the effects even if you don't know it. Higher mortgage rates, weaker dollar, market volatility. These aren't random. They're the direct result of China and other countries reducing dollar exposure, and it's going to get worse before it gets better. 3, the tipping point is closer than anyone admits. We're not at the beginning of this process. We're in the middle, maybe closer to the end. Spain took 80 years to collapse after their peak. Britain took 40 years. The Soviet Union took 900 days. The speed of collapse accelerates each time. If the dollar loses reserve currency status, it won't be a slow decline. It'll be sudden, brutal, and irreversible. And China, moving $688 billion out of the US system, is one of the clearest signals that we're approaching that moment. Final truth. China didn't move $688 billion out of the US financial system to hurt America. They did it to protect China. They watched Russia lose $300 billion overnight. They saw the dollar used as a weapon, and they decided they wouldn't be next. But the effect is the same. Every dollar China pulls out is one less dollar supporting US debt, one less vote of confidence in American stability, one less reason for the world to hold dollars. And when enough countries make the same calculation China made, the dollar's dominance ends. Not because of war, not because of conquest, because the world simply stops needing it. We've been here before, 3 times in 500 years. And every time, the declining power refused to believe it was happening until it was too late. Spain thought they were invincible. Britain thought the empire would last forever. The Soviet Union thought communism had won. They were all wrong. And if you think American exceptionalism means the dollar's dominance is permanent, you're repeating their mistake. $688 billion is not the end. It's the acceleration. And what comes next will redefine global power for the next century. If this showed you a pattern you'd never seen before, if you understand now that China's treasury sales aren't just finance but strategy, then you're seeing what most people miss. Subscribe to this channel, because the next phase of this story is already unfolding. And when the dollar's reserve status finally breaks, you'll want to understand why. The answers aren't in the future. They're in the pattern. And the pattern says China just made the move that changes everything.